Good afternoon, good evening. I am Corey Phillips. I am doing my next Wealth Wednesday. Right now it's late, 9 p.m. here in Illinois. I'm the founder and CEO of Social Storm LLC, and I'll be doing my next Wealth Wednesdays. There's so much going on, from different interest rates to a lot of stuff in the business world. So how can we utilize this information to build wealth? This is information that we can all utilize to change our life and share it to our community. Make sure to use this information for research purposes only. Consult with a financial advisor before you make any investment decisions, before you make any things like that. So it's important for us to use this information, share it to our family, and we can continue to change our communities. So currently it's September 3rd. It's September. We've seen a lot of volatility, but we see a lot of gains over recent days. Seeing current mixed signals within the economy. I'm expected in September. We see a lot of consumer discretionary stocks, and then we see a lot of stuff within the job market since Labor Day. Recent news last week, we mentioned about the jobless killings. There's more unemployment than there are job openings. So there's 7.2 million unemployed Americans. There's 7.1 million job openings. This is the first time since April 2021 where there's more unemployed than jobs available. So 0.99 jobs per unemployed person is down 0.1.05 in June. And this indicates that there's going to continue to be towards more momentum towards a rate cut. Because the United States economy is expensive and inflation. So in order to have a 95 to almost 100% probability that we'll cut rates in September. And this shows, because of a weakening job market, gives the Fed the cover to cut the rates. So there's another thing. You look at things like commodities. Talk about gold. Gold is up 3,573 per ounce, up 1.1% today. It's been up over 33% this year. And that's something that shows a lot of volatility and less people being able to understand what's going to happen, just not as much consistency within the market. So you see a lot of people dive into commodities like gold, silver, cryptocurrency, things like that. So it's important to look at that. It's so important. We talked about job and unemployment numbers. A lot of wealthy individuals have continued to see a lot of these big businesses, corporations, increase their profits. And I'll mention that later. And that shows for most Americans, that's not true. Most Americans are feeling it in their pockets. They're feeling an economy which is high, where inflation is rising, where their goods and services is costing more. It costs so much money for many of the things like real estate, going education. The prices of that is increasing each and every year. And for most Americans, that American dream is something that might not be attainable for most people at this current market. So that's something that we have to be aware of, that we talk about, there's more money being flowed into the economy, these companies becoming more profitable than ever, but at what cost? Most Americans don't have $1,000 in their bank account. Most people don't have 6 months to a year left in their savings account if they were to lose their job. And we yet have more automation, more information in a world where things are continuing to become more automated, where we need to be able to have more people to have our economy grow. And what good does it have if only the top 1% holds 90% of the world's wealth? Most people cannot be able to live. So that's something that's important for us to understand. So looking at the jobless claims, with there being less jobs, but the economy is still going. A lot of people think that just because people are being unemployed, that means the stock market is going to go down, but that might not be true 100% of the time. Because when you look at it, a lot of these companies are continuing to make more money with artificial intelligence without having less employees. So over the course of these years, you see lowering interest rates over the next couple of months, and a lower interest rates increases the profit margins for many of these companies. And at the same time, with the lowering interest rates, makes cash easier to borrow and makes cash cheaper, which makes these companies make more profits. Tech companies are going to continue to go up. And then that makes things, over the long run, inflation is going to go up, but these profit margins are going to go up, and they're going to be able to do that off of hiring less people. because of AI. So you have a world where you have a majority of these tech companies, big millionaires and billionaire trillion-dollar companies making all this money with less people. So we can't bet on the job market continuing to go down because it's something that's slow since last year. This has an account for 2025 as there's been an increase in spending on artificial intelligence, increase in government layoffs, increase in disinvestment in different communities. So we'll see where the data goes, but it's important to look at that. So your portfolio, you see increase in the margins from different companies. You've seen a lot of volatility within cryptocurrency and then commodities. Gold doesn't lie. It's telling us about market fear. You see all-time highs. There means uncertainty. There's currency concerns with the devaluation of the US dollar. And then there's a portfolio protection is needed. So that's why you see a lot of these institutions and corporations put their money into gold. I'm not saying just to buy gold, but understand what it signals. Gold is digital gold, something that's appreciated over time. It's something that usually different institutions go into when there's times of distress, times where the market, US equities are not giving as much returns. So people usually put their money into gold. And then looking at employment connection is that job insecurity doesn't mean wealth insecurity. A lot of the different things that we see every day, a lot of these companies, it's important for us to invest. And investing is not an option, it's a necessity. If you're someone who did not invest your money, time value, money, the money worth today is worth the money tomorrow. So if you're not making your money work for you, you're going to continue to be in a situation where things get more expensive and it's going to get out of touch, especially if you're someone that's just working in middle class. It's important to have other streams of income, whether that's working an extra job, whether that's starting a business, whether that's doing other things, finding ways to make money, because things are going to get expensive. And if you don't prepare now, you wish you did later. So to be able to have their assets work for you when your job doesn't work, because eventually one day you're going to want to retire, you're eventually want to start a family, you're eventually going to want to travel the world, and you want to be able to have your assets work for you while you sleep. And then also community wealth during shifts is that a lot of economic uncertainty is where the biggest wealth transfer opportunities occur. The people who buy different companies at a discount, our community cannot afford to miss these cycles because it's the most important age of automation and AI that we cannot afford to be taken out. The preparation is panic every single time. Prepare so you don't have to get ready. So that's something that we have to continue to go. We look at the job openings, like I said, 12 million peaks in 2022. And then healthcare had the sector cut of 181,000 openings. The retail sector had over 110,000 openings, 85,000 jobs a month on average this year versus 168,000 last year. So significantly, almost cut in half. While you see a lot of things like silver going up 43%, outperforming gold. So I want you to understand that many different things are happening, so you can be aware, not be fearful, but be aware that things are starting to get interesting. The markets are starting to get volatile, but you need to understand that it's so important to do this. So right now you look at gold, it says all-time high, hit September 25, over 3,573. Like I said, signals fear, fleeing traditional markets for safety. You see that now because of economic uncertainty, and you see a lot of geopolitical tensions with tariffs and many on Fed policy concerns as far as the federal funds rate, and as that continues to go down, and what that new chair may see in next year, might continue to make uncertainty within the market. And you see this during 2020 COVID pandemic when gold broke 2,000. Last time it hit this high, over 2,000, the markets was basically showing a signal for what was to come as far as a slowing economy and things not being as good as they seem. So looking to understand this in economics is that why gold is like an insurance for a lot of these companies. It's because it's something that can't be printed or digitally manipulated like currencies. It's an inflation hedge. So like it shows finite supplies, maintains purchasing power when currencies weaken, like the US dollar. The US dollar has weakened tremendously this year. So you see a lot of different people put their money into gold, silver, commodities, cryptocurrencies. So it's something that can move in opposition of stocks. It's not correlated with the stock market. It's providing that portfolio balance because you can't have 100% in stocks. You have to be able to have that diversification And this monetary policy response is with the Fed's cut rates, there's non-yielding assets become more attractive to investors. So that's something for many of us to take into consideration. But the psychology behind gold buying is that it's a risk-off of sentiment. When fear spikes, investors sell stocks and they go into safety. And the currency devaluation, like I mentioned, is something that protects against the Fed printing more and more money. That gold is something that continues to go up. And this geopolitical hedge is that universal store of value, typically during international tensions, whether that's war, conflict, things like that. Typical institutions and investors pool their money into commodities like gold and silver. And then we talk about a debate about is Bitcoin is digital gold. So thing is, for Bitcoin, for people who don't know, it's a decentralized currency, which people consider digital gold. There's only a limited supply of it ever created, with only 21 million maximum coins versus unlimited currency printing. So as the devaluation of the US dollar goes down, as we print more and more money, and with the risk of US dollar potentially one day being off the world currency, decentralization is key. It's not controlled by a government or central bank, but it offers portfolio diversification, sometimes more moves independent of more traditional assets. So looking at the reality of Bitcoin over the past 10 years, Bitcoin's been the highest performing asset of all those asset classes. In 2020, Bitcoin fell when stocks initially, but it did not fall not against them. You see a lot of institutional behaviors when margin calls hit, where the market goes down, investors sell all the risky assets, including cryptocurrency. But volatility problem is too volatile to be a reliable store of value during true crisis. It hasn't been true proven yet, but we see a lot of correlation. But a lot of correlation increasing towards digital gold as more institutions adapt cryptocurrency and it moves more like tech stocks. So that's something that we have to look out for. It's not confirmed, it's very risky, but looking at Bitcoin is something that people can see a stored of value with it only being a limited supply versus money like US dollar being printed unlimited. So that's something to look out for. So what these signals mean for your portfolio, what does that mean for you? Just economic uncertainty ahead. It's like smart money is preparing for a potential downturn. You see the dollar weakness as expected, like you've seen. The federal rate cuts typically weaken a currency. You said better safe haven options, gold, treasury bonds, cash, more liable during stress. Have cash on hand. So you saw Warren Buffett put $5 million into UNH, United Healthcare, but he still has majority of his money sitting on the sideline because this market is one of the most expensive markets that we've seen in the last 10 years. So it's important for us to understand what these markets really mean. A lot of safe havens during the current market reality is you see a lot of tech company risk, a higher concentration of tech companies. When concentration is high, these crashes can be more severe. So having gold as your portfolio insurance can protect, even if tech bubble would eventually pop or something were to happen where the stocks were increasingly concentrated, were to collapse. So economic weakness is job market softening, drives flight to safety. So that's important for us to understand. And the real world application for the community is that being able to have 5 to 10% portfolio in gold, small allocation to be able to have that meaningful protection against many different things. Have physical versus paper. Having gold ETFs is easier to buy and sell than the physical gold coins or gold bars, which most people don't have. And don't go overboard. It doesn't pay dividends and it doesn't or grow earnings. So it's something, a commodity. So it's understanding to utilize that. Being able to have Bitcoin and cryptocurrency and commodities as a position with your portfolio, but don't put all your eggs in one basket. The safe havens is what truly preserves wealth. We talk about being able to make all this money when the stock market goes up, but people typically overextend themselves and don't be able to prepare for economic downturns and events where we can see a lot of different things like tariffs. You have an insurance mindset. Hope you never need it, but you're glad you have it, like having extra cash on hand. Rebalance your portfolio. When gold rises a lot, consider taking some profits from certain companies that you might have overextended in. But it's something that's important. For regular people, you see a lot of things going forward. We need to continue to understand that you need asset owners benefit with things like gold. Non-asset owners lose. Inflation eats purchasing power over cash and wages, and then the gap continues to widen. as the rich own more assets, while the poor rely on different wages that don't keep up with inflation, the cost of living, and things like that. We've seen this historical context many times. We see economic expansion. Typically, most people put their money into different stocks outperforming gold, and gold underperforms. But you see economic uncertainty, gold outperforms stocks, while the stocks are very volatile. But we're transitioning from both expansion to uncertainty phase within the economy. But it doesn't replace stock investing, but it complements it. People talk about why should I have stocks, cryptocurrency, commodities, gold, silver, own all asset classes. People talk about having one, but being able to have a diversified portfolio is truly what keeps people knowing. Economic knowledge is the power. Understanding these cycles is what can transform your positions and how you can build long-term sustainable wealth regardless of the economy. The average rate of these U.S. stock market has been average September. Typically is typically the worst month for investing, usually negative 0.7%, and only 44% of people finish positive. But since 1928, the S&P decline averaged 1% and ended lower 56% of the time. And over the last 5 years, only 1 of 5 Septembers finished higher, averaging a decline of 1.4%. But like I mentioned, September doesn't go down just because of just things happening, but it happens because of institutional rebalancing. Many mutual funds, hedge funds, rebalance portfolios, tax loss harvesting, investors sell underperforming stocks that can offset their gains. And then also U.S. fiscal year ends September 30th. So there's a big reason why a lot of these companies end up pulling their money out. And then Fed policy review is something that review monetary policy in the month of September. And then a lot of consumer discretionary spending slows at the summer as people go back to school, go back to work. Back to the concentration of tech stocks. The market reality is that only over IT sector overweight is about 32% of the S&P 500. 1/3 of the entire market is in the Magnificent Seven, which is Apple, Microsoft, NVIDIA, Alphabet, which is Google, Amazon, Meta, Tesla is 40% of the market cap of the S&P 500. And then top 10 companies, nearly 40% of the S&P 500 market cap. So the earnings concentrations at the top 10%, top 10 companies generate 30% of all S&P 500 earnings. This is a time where it's more extreme. The top 10% of the U.S. has a 39% market weight versus the dot-com bubble of 2000 were only 27%. Today's concentration is backed by real earnings. 30% total of the dot-com was speculation. So it's important for us to understand that these top 10 companies are holding the weight of the majority of the U.S. stock market. Majority of the small and mid-cap companies are not performing. They've been sideways over the last couple of years. And the corporate margins have increased for a lot of these hyperscalers as they have more money, more cash, and reinvestment to AI, while majority of U.S. companies are not performing. So don't get that twisted that the United States stock market is going up, but in reality, only a select few companies are going to the top. Another news from today, you saw Oracle had a $90 billion day, and what that really represents. The one company gained 250 billion market cap in a single day today. That most Americans are struggling with jobs insecurity, revised unemployment data, but wealth is increasingly concentrated in the top 1%. If you own the S&P 500, 40% is tied to just 10 companies. So we need to understand that for phase one, economic weakness creates policy response. Job market softening, Fed cuts rates, cheaper capital for big tech like Oracle, NVIDIA, Facebook, all those different companies, which translates to economic plan for workers becomes rocket fuel for tech stocks. And then capital flow, concentration, cheaper money flows into safer big tech stocks, while the rich get richer, concentration increases and the wealth cap continues to widen. And then phase three is index investing amplifies the concentration. Everyone continues to buy the S&P 500, and then money automatically flows into those biggest companies that have the biggest risk. But your reality is that trying to diversify is concentrating in the same stocks. So you think I own the S&P 500, but I'm diversified, but 40% of your money is into top 10 tech companies. If tech crashes, your diversified portfolio crashes as well. So you don't want to put all your eggs in tech. You don't want to be able to have that in one basket because they're very volatile. And the second that interest rates rise and unemployment economy goes in shambles, tech companies typically fall. So you want to be able to have a few stocks that drive there's a few stocks that have been driving the market, but continue to you look at the market sentiment and then swings become more extreme and less predictable. But they always reverse. The biggest stocks eventually underperform, and you know that it could be months or years, but history shows it happens every single time. Prepare when leadership changes for which companies are continuing to take the next wave. Don't fight the trend, but prepare for a different reversal. This tech concentration is here to stay for now, but there'll be smart positioning, own some tech exposure, but don't bet everything on NVIDIA, everything on Apple, everything on Tesla. Hedge your bets and have international stocks, small caps, value stocks underperforming, but may lead the next cycle. So that's something that's important. Oracle moved up. They became, their CEO Ellison became the most richest, wealthiest person in the world, surpassing Elon Musk after they gained 90 billion in market cap. But I want you to look for the next infrastructure play. I don't want you to look at, okay, why can I buy Oracle now? It says all-time high. Why would you buy it now? Wait for it to correct. Look what companies are leading the way for artificial intelligence. Who are the people that are building up the energy supply? Who are the people that is building the data centers? Who are the people that have the AI agents? Who are the people that are building large language models? Who are the people producing the chips? Who are the people cooling the AI data centers? Who are the people that are critical in this total AI revolution, which is here to stay, and who are continuing to change the world? Look at those type of companies and continue to have that as your diversification strategy. Own an asset class like stocks, bonds, real estate, commodities. U.S. concentration, you need more international exposure, matters more. And if you see the stock market going up, you need to be able to dollar cost average through different concentration cycles, because as these stocks go up, then go down. If you just go and have time in the market, outperforms time in the market. So you can't predict the next big dip, but just be able to have that money grow consistently, and do not buy companies at its all-time high, but buy it as it goes down. But I want you to know that the economic reality for our community is that there's been 911,000 jobs reversed downward. Hiring is freezing, but asset prices are rising. The Fed cut benefits asset owners, but not people who are not owning assets. If you do not own assets in this new economy, you will be in a world where things are going to get more expensive. Things are going to get a lot worse. But if you're someone who has cash, who's someone who has positioned himself as an investor, you can be able to be prepared and take advantage of some of this opportunity that you see in front of you. The wealth gap is continuing to widen each and every day, and the less people that have access to this different companies and taking advantage of the AI revolution, the more that we'll see this volatility and widen what wealth gap. Instead of buying different clothes, instead of trying to look cool, instead of going on expensive vacations, you need to be able to position your family so that you can be able to have an all-weather portfolio position, regardless of if the stock market goes all the way up or it goes down. We're not going to go back to 2% interest rates, no matter how much they try to do it. Inflation is too high, and we have too much debt, and there's not enough jobs. We're not going back to 2%. 2% interest rates in the 2010s after 2008 over the course of time is not a reality in this next wave. So we need to continue to understand that. U.S. manufacturing is not going to come back in 2 years. It's going to take 5, 10, 15, 20 years. Just because you do tariffs does not mean you're going to get U.S. economy is going to flow. It's too expensive to produce things in the United States, but we're building the infrastructure for the future. So look at which companies that are not heavily risked through the supply chain and things like that and tariffs. Look at some of the beating up healthcare companies as this administration has continued to bash healthcare. Look at a lot of the manufacturing companies that are discounted. Look at a lot of these companies that are still very good, but due to some of these short-term correction and market sentiment, that a lot of these companies are overvalued, and a lot of these companies have a lot of opportunity. So take advantage of the noise. Stop paying attention to noise. You watch it every single day. That will keep you fearful. That will keep you from not taking advantage of opportunities, keep you distracted. But what you really need to do is lock in, and you'll change your life tremendously. Cut out the noise, and the rest becomes easy. This is something that we need to understand, that just build up your skill set. The economy's changing. You can't just rely on just your job. You have to become an entrepreneur. You have to find some sort of side hustle. You have to be able to invest. You have to start owning assets. You don't have to be an entrepreneur, but you have to either find a way to make more money in this new economy, because things are getting worse. And if you have to prepare now, so you don't have to be able to struggle when things get worse. We don't know. The market does not like uncertainty. We do not like terrorists. We do not like geopolitical tensions. That is not good for anyone. The United States stock market has been resilient, but we have to prepare for the worst regardless of what happens. But the United States stock market has recovered 100% of the time. So we need to be able to prepare ourselves so we can be able to change our communities and continue to invest our money and continue to build up as these opportunities present itself. So I want you to understand, just looking at the bigger picture, is that we study many of these macro trends, but don't look at it and be fearful of these jobless claims, the economy, interest rates, things like that. Utilize that as an opportunity to position yourself, get these companies at a discount, be able to lock in and find a way that you can maybe start a business. You can maybe work with your family, start a side hustle, find all those different things that can help you get some extra source of income and deploy into some of these top companies that's in artificial intelligence. Like, look at these companies like NVIDIA, like Microsoft, like look at Oracle, all these different companies that are paving the way for AI, which is here to stay, that can transform your life. And the biggest wealth transfer is happening right now. The people who panic are the people that are going to lose out on opportunities. But the people who prepare are the people who not react to the headlines, people who understand cycles, people who understands what happens in September, the microcycles, will see the bigger picture and take advantage of this opportunity. But I want you to remember that time in the market is the most important thing. Regardless of what happens, all this information doesn't matter if you don't know how to execute, if you don't take that next step for your family. Today's fear creates tomorrow's fortune. I want you to understand that those who continue to take their life seriously, those who are young in Gen Z, who understand the value of compound interest, will change your life. Just starting with little money that you have now, don't think that age is a reason for you not invest. Don't create those excuses for yourself. Find a way to put yourself in a position so that you can change your life. Investing is not just for the wealthy. Investing is meant for people like regular, everyday people to be able to take advantage and be financially free. Being financially free, regardless of what your career, is so important. You can make six figures, but if you don't have that retirement, you don't have to own your house, you don't have all these different things, you're eventually going to be in that position where you don't know where you might be when you're retired. As you age, as you have health conditions, as you age, all those different things plays a role. So being financially free can put you in a position where you can help your families thrive, create trust for your kids and their kids, so that they can live a life where they don't have to worry about money, where they can pick whatever school they want to go to, where they can explore whatever career that they aspire to be, where they can truly give back to the community. Being able to have this more wealth can give more opportunity to others, not just yourself. And we truly need those types of people within our community, not just here to make money, but here for the passion of actually helping people that need it, serving people, having purpose, not just making money to make themselves rich, but be able to make money so they can have more impact in the world. And that's something that the reason I teach this information, so that we can be able to change our communities. They can see other role models and people that are doing things that are productive, that they see other people doing things that they see that there's hope, that there's a path that they can become successful, that this is something that they can do that gets them off the streets, something that they can do to change their family's life, that they know that they don't have to just rely on only a job, but they can create their job, that they can build wealth, that they can change their life. This is something that we all should be able to take advantage of in this economy, in this world. And I'm truly here to inspire you all. I'm thankful for all the people who supported me, and how we're going to continue to build this platform. We're going to continue to build the community so that we can not just make financial literacy only for the elite, but make it right for people to deserve it. So use this information to build wealth, use this information to change your life, and truly appreciate you all. Make sure to follow me on Instagram at CoreyPhillips3. Follow us on YouTube, on Instagram, on Twitch. As we continue to change this information, we will be having some high-level guests coming soon. So stay tuned each and every day, and you all stay blessed. Have an amazing night.